Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull bear point and figure market breadth summary chart for April 7th, 2019. Market breadth. With this past week's market advance, our bull bear point and figure ratio at 1.44 rose from 1.15 last week. The total count of securities in bullish or bearish patterns increased 2% to 3,016. The count of bearish stocks decreased 10%, while the count of stocks in bullish patterns increased 12%. The Pirls P&F Market Breadth Summary Chart shows us a market now 13 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data, from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 421 points for the first advance in 5 weeks. At a positive 420.63 points, it continues below the January 2018 top and continues below the February 2017 top, the June 2018 top, the February 2019 top, and the October 2017 top, and it continues above the remaining 3 tops above plus 100 in the last 30 months, as well as above all 5 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in accumulation mode on lower average daily volume. Momentum. The CCI 20 daily, in a Woody's uptrend, is now at a positive 163.80, up from a positive 73.16 last week. At Tuesday 3/26 close, it formed a zero-line reject long entry signal within the plus or minus 50 range, and did not drop below the zero-line reject pivot point for the remainder of last week. Then rose substantially this past week. We will continue to follow this trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 3 weeks ago, while the daily CCI 20 began a Woody's uptrend 11 weeks ago. The CCI 20 weekly, in a Woody's uptrend, at a positive 140.60, up from a positive 116.48 last week. With 9 weeks above zero, it continues in a Woody's uptrend and continues outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation, the last 2 weeks. All of the top 5 industries are positive, and only 2 of the bottom 5 are negative. Summary: brokers and some tech on the top, gold and silver and REITs on the bottom. Bullish brokers has left the bottom 5 and entered the top 5. Computer hardware and semis have entered the top 5. Gold and silver has left the top 5 and entered the bottom 5. Bearish REITs has entered the bottom 5. S&P Retail and KBW Bank have left the top 5. Oil and oil services have left the bottom 5. Focus this week from www.bellacaledonia.org.uk. Kondrativ, Riding the Economic Wave. The following are some key points and a chart from Part 1. Forbes Business Magazine warns, quote, "The biggest problem for the global economy in 2019 will be massive business failures that could lead to bank failures in emerging markets," end quote. The international economy operates in pulses christened Kondrativ waves after Nikolai Kondrativ, 1892 to 1938, the Russian economist and statistician who first identified them. These K-waves consist of an expansionary upswing lasting normally 15 to 20 years, followed by a downswing of similar length. We are now in such a downswing that could last till the 2030s. What causes Kondrativ pulses? Social and economic conditions mature to spark a runaway investment boom in the latest cluster of new technologies. After a period, excess investment and increased competition lower rates of profitability, curbing the boom. At the same time, because this is as much a sociological as an economic process, growth expands the global workforce, both in numbers and geographically. The new militant workforce launches social struggles to capture some of the wealth created in the boom. This, in turn, adds to the squeeze on profits. The peak and early downwave are characterized by violent social conflicts, whose outcome determines the length of the contraction. Where precisely are we in the Kondrativ cycle? There is a dispute about this. Economists convinced by the Kondrativ theory largely agree there was a strong up phase following the Second World War, lasting till the early 1970s. This was driven by the collapse in European wages imposed earlier by the Nazis and by the universal adoption of Fordist mass production techniques. This expansion turned into a downsizing in the 1970s and early 1980s as profitability declined and the revived European economies, linked through the early common market, eroded American competitiveness. The dispute concerns what happened next. The era of Reagan, Thatcher, neoliberalism, and globalization, running up to the present. In 1998, the American economic historian Robert Brenner published a hugely influential account of global capitalism, which claimed to identify a super downswing running from circa 1970 to the turn of the millennium. Brenner rejected the notion global capitalism had or was likely to regain profitability, citing excess capacity rather than working-class resistance as the primary driver. He pointed to the sudden stagnation in the Japanese economy in the 1990s as a precursor for the West's future. I have always believed that Brenner was not just wrong, but wildly wrong. The Reagan-Thatcher era created precisely the conditions for a new upswing by smashing the trade unions and incorporating the former Soviet Union and Maoist China into an expanded capitalist marketplace, complete with hundreds of millions of new cheap workers. The result was a boom based on investing in a cluster of new technologies: the silicon chip, the internet, and mobile phone. On a political level, the social welfare gains of the working class won after World War II were eroded to reduce taxes and boost profits. This upswing lasted till the bank crash of 2010. There has been a wave of Chinese and Asian working class resistance to exploitation, which has eroded profits. In the West, paradoxically, the historic defeat of the unions has flatlined wages. As a result, goods can be sold and profits maintained only by bolstering consumption through easy personal debt. That makes the Western capitalist model unsustainable and prone to endemic bank failure. The banks and their tame accounting firms are busy covering up this chronic instability via wholesale fraud. As a result, we are nowhere near the bottom of this K-wave. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. For Sand to Pirls Stock Market Commentary, I'm Cynthia Pearl, hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.